Gold is approaching a major liquidity zone, and smart money may already be positioning before the next expansion move. Welcome to This Explainer. Today, we're tearing down the retail noise and looking at the markets strictly through an institutional lens. We're going to conduct a deep, cinematic breakdown of gold, specifically the XAU to USD pair, using smart money concepts and order flow logic. The charts are aligning right now for a critical expansion phase. Listen, if you aren't tracking the footprint of the market makers, you're literally stepping in front of a freight train. Let's dive right in. While retail traders are out there guessing, desperately trying to catch falling knives or pick tops based on lagging indicators, the market makers are already setting up the next major sweep. They operate purely on liquidity. Our job in this breakdown is to figure out exactly where they're placing their traps so we can align with their order flow. So here is our top-down briefing for today. First, market context and fundamentals. Second, market structure analysis. Third, the smart money setup. And finally, trade execution scenarios. Starting off with Section 1, market context and fundamentals. The macro drivers behind the order flow. Look, you simply cannot trade effectively without understanding the fundamentals driving the volume. Right now, we're facing some very heavy crosscurrents. Geopolitically, U.S. forces have conducted self-defense strikes in southern Iran, which instantly triggered a flight to safety. But the signals are incredibly mixed right now. We're hearing about a potential 2-month truce, yet concurrently there are threats of new military strikes if talks break down. Because of these supply threats, WTI crude oil recently surged to $91 a barrel. And what happens when oil spikes? Global inflation fears reignite. That pushes capital directly into the US dollar. We've seen the DXY climb above the 99.10 level on clear institutional accumulation, and that creates a massive headwind for gold. To put that inflation fear into perspective, just look at the CME Fed Watch tool. Because of rising energy costs, it's now showing a greater than 50% probability that the Federal Reserve will execute another rate hike by the end of the year. That expectation of tighter monetary policy fundamentally crushes non-yielding assets like gold. The macro narrative right now is overwhelmingly bearish. Moving into Section 2, market structure analysis. Let's look at the technical translation on the higher timeframes. Let's see how that macro Y translates to the technical where on the charts. If we look at the pristine institutional footprint on the 4-hour chart, the overarching structure is heavily bearish. We're consistently printing lower highs and lower lows. Notice this violent drop right here? That's a textbook break of structure below the 4.580 level. It completely destroyed the previous bullish structure. Furthermore, check out the moving averages. Prices operating firmly below both the 50 and 100 EMAs. Not only are they pointing down, but the gap between them is actually expanding. Seller momentum is absolutely in control. Now, let's map out the liquidity. Smart money algorithms are drawn to liquidity pools. Currently, buy-side liquidity is resting behind a massive firewall at the 4.600 level, which perfectly aligns with the 21-day SMA. Market makers have aggressively defended that level. Conversely, the sell-side liquidity is sitting completely exposed below the previous lows at 4.480. That is our ultimate magnet. As of now, we have a confirmed break of structure to the downside, and absolutely zero sign of a bullish change of character. Every single attempt to rebound is just getting sharply rejected at the moving averages. Zooming into the 1-hour execution timeframe, the story becomes even clearer. Look at these multiple rejection wicks printing exactly in the 4.560 to 4.570 premium supply zone. Every time retail tries to push the price up to catch a reversal, they step right into a zone where institutions have stacked limit sell orders. These wicks are the literal footprints of smart money absorbing that retail buy pressure. And check this out. The relative strength index on the daily time frame is currently sitting around 43. This is crucial because it tells us that downward momentum is steady and dominant, but we're nowhere near oversold territory yet. The market makers still have plenty of room to drive this asset down to sweep that sell-side liquidity without triggering mean reversion algorithms. All right, Section 3, smart money setup, the trap and the mitigation strategy. Before we talk execution, we need to identify the trap so you don't fall into it. Right now, uninformed retail traders are looking at the 4.530 to 4.540 level and thinking, well, it's dropped enough, this must be the bottom. They're stepping in front of a macro-driven sell-off. By placing their stop losses just below this current consolidation, they're actively manufacturing a fresh, highly concentrated pool of liquidity. Market makers see this. They will almost certainly sweep this trap on their way down to the true target at 4.500. Do not become their liquidity. If you need further proof of this distribution, just drop down to the 15-minute chart. Notice the volume profiling here. The volume violently spikes specifically on these aggressive downward bearish candles, while it completely dries up on the weak green retracements. This is a textbook smart money footprint. They are actively unloading positions and pushing price down, letting retail struggle to push it up on low volume before slamming it back down again. Which brings us to Section 4, Trade Execution Scenarios. High probability institutional alignment. Knowing all of this, how do we actually trade it? We treat it like a strict institutional algorithm. 80% of our focus is on the high probability sell setup in alignment with the dominant trend. Step 1, exercise patience. We wait for a retracement and mitigation at our premium entry zone between 4.555 and 4.565. Step 2, protect your capital. Set a strict invalidation stop loss place just above the recent 4-hour high at 4.585. If it breaks that, our structure is compromised. Step 3, target the ultimate sell-side liquidity sweep for your take profit, aiming right for that 4.490 to 4.500 psychological level. This setup provides a highly professional risk-to-reward ratio of 1 to 2.5. But listen closely, we do not just blindly enter at the zone. We require structural confirmation. We need to see a 15-minute candle close definitively below 4.550, accompanied by elevated institutional level volume. That proves the sellers have stepped back in to defend their supply block. Now, as professional analysts, we always have a contingency. There is a high-risk counter-trend buy scenario, but it is strictly for a short-term mitigation bounce. You only look at this after that heavy sell-side liquidity sweep at 4.485 has occurred. The entry is at 4.485, tight stop loss at 4.460, targeting the 4.530 area. But hear me clearly on this, the strict condition for this trade is seeing a massive volume-backed bullish pin bar or engulfing candle at the support level, proving the liquidity sweep is officially over. Let's summarize with our final directive. Do not overcomplicate this. The macro fundamentals are heavily bearish for gold. The US dollar remains the dominant safe haven king. The institutional order flow is clear. Sell the rallies near the 4.560 supply zone, trail your stops, and wait patiently for that ultimate sell-side liquidity sweep at the 4.480 target. Trade what you see, follow the volume, and respect the structure. And that wraps up our explainer on this XAU/USD order flow setup. If you want more institutional-style gold analysis using smart money concepts and ICT methodology, make sure you subscribe to the channel. You can open your trading account using the link in the pinned comment to follow future market breakdowns and trading opportunities. The institutions are already placing their traps. The only question is, will you be trading alongside them, or will you become their liquidity? Stay disciplined out there, and I'll see you in the next breakdown.